Keki Mistry, Vice Chairman and CEO at HDFC Limited, joining in the show right now. Keki, morning. Your profits have come in line as always with analyst expectations. However, even if we adjust the profits with the one-time gain of the HDFC Life IPO last year, the overall profit growth is in single digits. What's led to this kind of performance?
You know, what you have to understand is that in the previous year's figures, you have to eliminate the profit on sale of investments, which happened because of listing of HDFC Life. So that had generated a profit of 5,250 crores of rupees. So if you remove the 5,250 crores of profits, the resultant tax thereon and the extra provisioning which was done at that point of time, and then compare the profit figure, the actual profit for the quarter is higher by 27%. If you remove profit on sale of investments, tax and provisioning, then the current quarter's profit is 2,984 crores compared to 2,352 crores in the third quarter of last year, which is 27% higher.
Right. So you've been able to maintain margins at 3.5% and spreads at 2.25% in a difficult liquidity environment as well. What led to this performance, and more importantly, are these kind of numbers and trajectories sustainable?
Well, the performance to my mind should be sustainable. Margins went up because the spreads were reasonably stable. Our spreads last time were they've been in the same band. This quarter was 2.26, last quarter was 2.28, so it's broadly been in the same band. The liquidity situation that you talked about in the third quarter did not really impact us because we saw quite a large flow of money into our deposit schemes. So we were not really impacted by the liquidity crisis in the market. We continued to lend money. We continued to give housing loans to customers, and the demand for housing loans continued to remain reasonably strong. If you look at the growth of individual loans on an AUM basis, the growth was 17% in the 9-month period this year compared to last.
Loan book growth has been healthy in the individual loan category. Given the context of tight liquidity and concerns in real estate sector, would you choose to be cautious on growth going ahead?
Well, first, let's talk about liquidity. You talked about tight liquidity, and I repeat that even in the worst of times when liquidity in India by and large was considered to be very tight in September and October, we did not really face any liquidity concerns. Our deposit growth, I mentioned earlier, in the quarter has been extremely healthy. So that's as far as liquidity goes. As far as stress in the real estate market is concerned, which is what you talked about, the stress is isolated in certain geographies, and it is more in the high-end market. If you look at the average loan amount for new loans we given in the current year, it is 26 lakhs and 90,000 rupees, which is typically middle-income housing and not the high-end market that you would see in a Mumbai or in a Delhi. We give loans to borrowers in the lower income group and in the economically weaker section. If you look at it in terms of numbers, 37% of the loans we gave in numbers were to borrowers in the economically weaker section or the lower income group. It was 37% in numbers and 18% in value. So 18% of the loan in value terms were to borrowers in the economically weaker section and lower income group, where the average loan amount is much lower. In the economically weaker section, the average loan amount is 10.1 lakhs. In the lower income group, the average loan amount is 17.6 lakhs.
Right, we've seen some inch up in terms of NPAs in the context of a tough environment. How has the breakup been in terms of individual and non-individual books and the treatment of IL&FS, the exposure there?
Gross non-performing loan number stands at 1.22%. Last quarter, as you said, was 1.13%. The 1.22%, if we break up between individuals and non-individuals, individuals' gross non-performing loan number is 68 basis points and non-individuals' gross non-performing loan number is 2.46%.
Right. There are liquidity concerns, Keki, that, given the high exposure of mutual funds to the SL group, NBFCs may also, further see tight liquidity condition. As an industry player, how is it that you're reading the current liquidity situation?
Well, my sense on the situation is that because of the crisis that some of the companies faced in September and October, because they had a very high focus on borrowing through commercial paper, in the last 3 months, most of these companies which had such a high focus on raising money through commercial paper have stopped doing that. So the amount of money which has been borrowed through commercial paper in this quarter would have been a lot lesser than was the case in the previous quarter. And you would see that the total amount of, I'm talking now as an industry, not HDFC. HDFC is extremely low. But even as an industry, the amount of money that would have been borrowed through commercial paper, which is really short-term money, would have been significantly lower as of December end.
Right. Any plans to sell stake in any of the subsidiaries, especially in general insurance?
No, not in the immediate present. At some point of time, we would look at listing the general insurance business, but that's certainly not going to be in a hurry, not going to be in the immediate present.
Mr. Mistry, thanks very much for joining us with those details. We wish you the very best for the future.